2025 was a good year in terms of absolute returns. So the NAV was up 20.4%, and that compared to the benchmark up 20.6% in the year. In terms of the dividend, another year of dividend growth. So the dividend was declared at 10.9p for the year, which is 2.8% growth on the previous year. And that's now the 13th year consecutively that we've grown the dividend. In terms of performance drivers in the year, so it was very much led by the equity portfolio and certainly financials within that. So we saw some of our insurance holdings, so the likes of M&G, the likes of Phoenix performing very robustly, certainly in the first half of the year, but also our banks holdings, so the likes of NatWest and Lloyds also performed very robustly in the year. In terms of some of the detractors, unfortunately it was a stock we didn't own, which is a very large constitution of the benchmark, but Rolls-Royce, given the strong share price performance, was actually a negative for relative returns. In terms of some of the stocks we held that were disappointing, Hilton Food Groups, unfortunately, struggling with a bit of inflation there, flowing through to fall in demand in terms of some of their key categories in seafood, in beef as well. And also Sodexo, our French contract caterer, also had a difficult year, lost a few contracts in the US there. So in terms of activity for the year, so within the equity portfolio, we bought new holdings in AXA, the French insurance company, but also the UK asset management business, Aberdeen. Both pay an attractive dividend, but also cheap relative to some of their peers as well. So within the bank exposure, we had a bit of a switch. So we sold out of our holding in BNP, the French bank, and actually bought into BBVA, which is the Spanish bank, has very strong market positions in the likes of Spain, Mexico and Turkey. And we think actually the dividend could grow quite aggressively over the next few years. Some of the holdings in the equity portfolio that we sold, so we sold out of Coca-Cola Hellenic Bottling Company, performed very robustly for the trust over the last few years. But actually we felt the valuation has now approached a level which didn't discount some of the risks to volume growth going forward, given the price increases we've seen over the last few years. Some of the other names we sold, Sabre Insurance, car insurance company, again, the valuation had recovered along with the profits. And again, just think there's more limited upside from here. And also SSE, the UK utility company, again, being a very good performer for us, just slightly worried about the returns the company makes on some of that renewable energy infrastructure spend we're seeing going in over the next few years, really. In terms of the bond portfolio, we actually added about a net 7 million to the portfolio, just recognising where bonds had underperformed equities over the last few years and just lowering that underweight we specifically had within the trust over the last few years. Still maintaining an overweight equities relative to bonds going forward, but just taking a little bit of risk off the table there as well. In terms of the outlook for 2026, I think we've got to be mindful of events going on currently in the Middle East and the surge in oil price we're seeing on the back of that. I think if we'd have taken a step back at the start of the year, we thought the equity market could make further gains supported by strong earnings growth, supported by lower inflation, lower interest rates. But I think the surge in oil price will have implications for that inflation outlook, typically higher inflation, slower economic growth, and those likely interest rate cuts that we thought were going to go ahead, likely to be on hold for the time being as well. I guess, in terms of that conflict, it's really going to be driven by the duration of it. If we do get some form of de-escalation in the short term, then actually we can go back to focusing on more fundamentals of companies and what the outlook could be for growth going forward. I think a prolonged conflict will have slightly different repercussions for inflation and economic growth going forward. However, at times like this, in uncertain times and volatile times, it's important to remain disciplined, really still trying to find those good quality companies that you think are undervalued, but also have the ability to not only pay a dividend, but also grow into the longer term. And that's what we're trying to do at the moment. Thank you.